everyone, welcome to my YouTube channel. My name is Tabitha. If you're new to this channel, welcome and subscribe for more videos. Today we are going to talk about investing, and investing in basic word is when you take your money and you put it somewhere where someone promised you to add something on top after a certain period of time. If you have $5, you keep it for 5 months, you get maybe $10. So before we get there, and then I will show you the agendas of today. Agendas of today include what is investing? Number 2, how inflation affects money growth. Why should you keep your money in the bank without gaining anything? And should you survive, will you survive 10 years later or 5 years later with little money? How to make money through investing. So these are the things that we are going to discuss, and I hope you're going to enjoy the video. And welcome again, and let's get started. Investing guide will give you like the investing, like you keep your money today, put it somewhere and have high expectation that it's going to grow. Instead of getting out $100 that you put in, you can get out $150. So that is investing. And then let's see how this guy in this picture achieve his investing. So you have to have a plan. Maybe say I will put $2 this month, and then next month you put another $2. Before you know it, it just grows, and then it grows, so that next year, if you want to buy something, you have enough money to buy that thing for that you're looking for. So this is how it will look. This is always like upward if you know what you're doing. If you're new to this channel and you already like what I'm doing, please subscribe for more videos. Investing is a long-term game, 15 to 30 years. Some other people can invest in short-term or medium-term, 5 years, 3 years, right? So it's a 15 years game, right? Let's say, for example, you want to buy a house as rental property and you'd want to stay in Toronto. So it means your mortgage will be high. So if your mortgage is high, even if you are renting out to people, you might be left with nothing. In fact, maybe you will have to get some money out of your pocket to keep up with all the bills, right? So you will need 15 years to pay off that house so you can start making money from the rental properties, because now you will be done with the mortgage. People will be paying you now to stay in your house, can now give you money that you can keep as the profit, right? So at least 15 to 30 years for most people. Whether it's stock that you're invested in, or maybe you're growing your money in a slower space, in a slower step by step in the bank. So it just depends on what you decide, right? It's 15 to 30 years game. So it's not like something that if you want to get into a market like 2-3 days later and then you do the trading. So that's the different thing. So if you're trading, you're doing short term, and then you're dealing with demand and supply, and you have to have a lot of time to do that. If you're doing investing, 15 to 30 years, it's a gradual form of growth and something that you will use later. Statistically, like a lot of people don't want to get into the market because they want to risk, like maybe Bob. Maybe Bob invests like some of this money, 10,000 last 5 years ago, and he lost everything. So why should I go there? What is the guarantee? So a lot of people, they avoid market instead of like studying it and how they should manage their risk. So over long term, stock market has been said to have increase in value overall. So this also put into account the time that this market was also down. Like last year, everyone saw it. Like if you were in the stock market trying to make some little money here and there, you could see like a lot of companies had a decrease in value. The stock of maybe, let's say for example, there's a time like TD was trading at $50. Now it's gone back to 79. There was a time BMO was trading at $49. Now it's gone back to 120 and 29 or 126. So there's like the overall growth of the stock also put into account the time when the market was down and how it recovered altogether. So it will become like a long-term trend that it has already been drawn, putting all those factors into consideration. So as you go into the stock market, you can also expect that there will be a time when there will be a market crash. And instead of you just running away and see like, let me save a little bit that I'm left with instead of losing everything. Sometimes you can keep on and hang on to your stocks, because until you sell your stock, that's when you lose. But if you don't sell them, you trust the company that you bought the stock, the number of your stock are never going to decrease. It's only the value of your stock that goes down. If your value of your stock goes down and you hang on to your stock that you have, the market will correct itself and then it will goes back to normal. So let me show you like what happened last year with BMO and how some investors who don't really understand the market lost their money. And then now they will be watching, seeing what happened next after the market crashed last year. So let's see. We were talking about stock market growing over time, right? So when it grows over time, we say it gained. See, that's all put into account the time when this market was crashing, the time when the market was, the prices were fluctuating, other companies hitting zero, other companies were just hanging in, and then other companies actually growing. Like last year, when you look here, there was market crash in March of 2020. During this time, a lot of companies became bankrupt, and then other companies actually grew. Like in this company, during this time, Tesla grew, and then also Amazon was growing too, and a lot of many other companies. So in the stock market, it's just like, it's an atmosphere that you have to familiarize yourself and see what are the factors that affect the market, so that when you are invested, you are not the one of the victim that is affected. So you need to put more into what you want to do, because market crash would be there, prices would be fluctuating, and there are also opportunities of upward movement of the prices in the future. Look at here, like if you see here, there was this, it has hit the ground. This is when a lot of companies were actually selling at discount. If you look at big banks of Canada, they were like selling at lower price then. I think BMO was trading as 50 something then. Yeah, it was trading around 50, 58 then, right? But now, like, look what happened. Like after some few months, going into 2020, we have been seeing it just fluctuating. Now in July here, when we are in July, BMO is trading at, actually at 125 now. You see, so market is very unpredictable. No one can tell what will happen tomorrow. And if you have the knowledge on really determine the factors that affect the market, and then you will be in good hands, and you will actually ride with with the market trend. So the market trend over time is upward. You have already seen, like in November, in March of 2020, it was down, like down, going uptrend, downtrend, oops, until some of the companies hit zero. Other companies hang in, other companies grew, and in overall, we all went back to the uptrend normal trend of the market. So it all went back to the normal size. You see here. So you see it's all gone back to normal, going back to normal. So now BMO, instead of trading at 50 something, now it's trading at 125. But what happened to some of the investors that had BMO stocks? So they saw BMO moving from 120 something, going down, heading down to 50s. So if someone who doesn't understand the market and the overall factors that affect the market, they will say, oh, I am seeing BMO is going to go bankrupt soon. So instead of me waiting until it hits zero, let me sell these stocks at this price. So they might have bought those stocks when they were trading at 8, 9. Now, because the market crashed and BMO was selling at 58, they sell it at 58. Do you see how much they lost in their stocks? So they lost $30 per each shares, and maybe they were owning 100 shares. So they lose money, and then this actually affect people. So for a lot of investors who understand the market, they do the long-term game. If they do the long-term game, and then they will be able to manage risks instead of panicking when BMO is getting to $58 a share. They hang in because they know there are factors that will affect the market, and the market will goes back to normal, and it will goes back to its height. Like its high now is like 126. So someone who had sold the shares at loss, now they're wishing if they had hang in and stay in there until the market corrects itself, and then now they will be selling their stocks at profit, or maybe if they want to hold it, and then they can hold it and continue to collect dividend on their stocks. Stock market is a long-term game, and you need to hang in. You need to understand the factors that affect the market. If you're a short-term investor, and then you know the factors that affect the market, and then if you're a long-term investor, and then you know what to look for and why you should hang in, because at the long run, the stock market corrects itself and goes back to its normal trading time, and then it doesn't really guarantee that there is no hard time that is going to come in the future. They're always coming back. So better. So gain and profit over the long term. So like what I had said, like there was a downside, and then it's all goes back to normal. This is 2021. After some years, after 1 year, it goes back to normal. And people had sold their stocks, they are now regretting, hoping that if they had hang in and keep it for some time, it will have grown back to 8 height. So like even me, I had like some shares of BMOs and I sold them at 97. Now I'm saying, like, what if I had stay in and now sell them at 127? How much money would I have made? I would have made $50 per share as a profit. So it's like market is not predictable, but in the long run, it will go back to normal. So put some factors inside that will keep you stay in the market instead of just running away and be the victim, okay? Do not be the victim. It's going to go back to its normal trend. Why invest your money then? Like, how it will help you to keep up with the inflation, right? It will help you to keep up with the inflation, because if you don't grow your money, the inflation will eat into your saving account that are more safe in the banks and all these things. And then after some 2 years, you are not able to afford anything because you did not grow your money, and now the prices of goods and services are higher and you cannot afford. Me, I've been a victim too, and a lot of people too will be victim like after some years, because if they don't do anything about inflation. So it's investing your money will make you make money by investing your money. To keep up with the inflation, how does that sound? Cost of goods and services goes up by 2% every year in the Western world. Maybe if you go to Europe, it's the same thing. Here in North America, it's the same thing. Prices of goods goes up 2% every year, which is very manageable. But if your money is not growing, your dollar today is not going to buy you a cup of iced coffee. The cup of iced coffee, you're not going to afford it next year, because you have to grow that $1 to maybe $1.50, so you can afford that iced coffee. So let's say, for example, you have a saving account of 8,000, right? That give you 0.75%, so which is 0.0075 as interest rate. And now add into it inflation minus inflation, subtract inflation inside, which means you will be losing money. Not like you will see your 8,000 has gone back to 6,000. No, it will still look as 8,000, right? But what you don't see is inflation is taking the value of that 8,000. It is less valuable, right? So your 8,000 is not going to buy you much 2 years later or 3 years later or 10 years later, right? You will need more money to buy things that you're buying now for 8,000. So what is the real return? What is the real return that you're supposed to look at when you are saving your money in the 3 years time? Can you actually determine what is the real return on that money that you're putting in? And how to determine this real return is like you take the nominal interest minus inflation. So let's see. 0.0075 is the interest that they have promised you that your money is going to be growing at 0.0075 minus inflation. Our overall inflation is about 2%, 0.02. So how much do you lose every year? The value 0.19, which is 1.9%, right? Let's see. 1.9%. The minus shows that the money is not gaining interest, it's actually losing value. Your 8,000 is losing value, and the next years, you're not going to be able to afford things that you're buying now for 8,000. So let's give you a very good example. Let's say, for example, in 2012, you had your 8,000 that you need to use to pay your rent. How many months will you pay for that with that 8,000? So your 8,000 and the 2-bedroom apartment is 1,600 then in 2012. How many months will you pay for your apartment? 5 months, right? Now keep your money in that account, in the bank account, in your bank account, and they promise to give you 0.0075 interest. So which means after 10 years, your 8,000 is still your 8,000. But will your 8,000 pay for your rent for 5 months? Is that going to happen? Let's see if it's going to happen then. Let's say your money did not grow and you still have your 8,000 10 years later. Not 10 years, 9 years later, right? I don't know. So you still have your 8,000. It never grew because you put it, you lent it to the bank, and they use it to make their money, build the bank money. They make more money using your money. And then because they were giving you 0.0075, your money was actually losing value. So you have your 8,000 in 2021, but how much can you buy with your 8,000? Let's say you want to you want to rent a place to stay, but how many months would you pay with your 8,000? Will it be 5 months like the way you did it in 2012? Or will you need more money to pay to cover the other 2 months? Let's see it. So now in 2021, Toronto, 2-bedroom apartment is 2,300. Can you afford it? Can you afford paying for 5 months like the way you did in 2012? No, your 8,000 will only pay you 3 months. So this is how inflation works. You put your money where it's safe, you think you're not losing money, you're losing money. Yes, because the value of money decreases every day. Decrease every day. You still have your 8,000, but it is not going to buy you things that it used to buy you. If you understand what I'm saying, yeah? Your 8,000 could pay you 5 months in 2012. Now your 8,000, because it never grew, you just gave it away to the bank so that they can use it to do their business. And every day you're just seeing some numbers and nothing is growing. Now they give it back to you in 2021, but you can only pay your rent for 3 months because you need more money. Every product prices and services prices have gone up by 2%, and you need more money. And this is why you want to put your money where it can grow so that your money will keep up with inflation, right? So let's see if we have more examples on how to explain. But how do you make money now with investing? If you know now how to take care of inflation, how do you make money? Let's say, for example, you don't want to lose no money and you don't want to go to the stock market. So what do you need to do when you want, if you're that kind of person that you are very safe, right? You want to be in the bank and know like there's someone assigned to take care of your account, right? So what you need to know to do is go there, tell them inflation is 2%. So why do you want to give me 2%? I know I'm not going to be growing no money on this top of this money. So has something that is higher than the inflation interest, right? You have something that is higher. So if you have something that is higher, you could subtract the inflation part, and at least your money is growing with something, maybe 1%, maybe 2%. So let's give you that example, that scenario now, right? We want to make money, so, but every person have different risk tolerance, right? We have different percentage of risk tolerance. There's people who don't want to lose no money. If they lose 1,000, they will lose the head tomorrow. So those kind of people, they want to be in the bank and safe, taken care of by someone. So if you go there, has something higher. If inflation is 2%, ask for at least 5%. Say, okay, this money, I don't need it in 1 month, in 1 year time. Can you put it somewhere where it can hand like me 5%? So now if you are handing 5%, at least you are taking care, of, you have already taken care of inflation. The difference between inflation and the interest that you have been given would be the percentage of which your money can grow, right? So let's see. Really return when you have 5% interest. When you get 5% interest minus the inflation, your money will be growing by 3%, which is high, right? So that's the amount. You're okay with it? At least you can afford something when next year or 2 years to come, right? You will have at least $3 extra on your $100 saving account, right? Let's see. So now, first year, you can now calculate your real return on your money. You have $100, you put it into your saving account, you're getting nominal amount of 5%, but you subtract the inflation from it, you're now left with 3%, which is like the real return. So if you times a year, 1 year, you will be getting $103. So if you go out next year, you can afford more because you have extra $3. But if you keep your money for next year, there's something called compound interest, right? So the amount that you had already got last year would be now the principal times the interest that you got, right? 0.03 times that here, right? So now you have extra $3 on top of your thing. And then next year, the third year, all this amount will gain interest again. And over the year, your account will be growing gradually because it's compounding and compounding every year. So this is how people who are very safe and they are conservative and they don't want to lose no money can make money. So you go there, demand what you deserve because it's your money. They're going to make money with it. So if they are going to make money with it, they have to give you something higher. Most of the time they take advantage of people because they don't know, they assume like not everyone understands the language of money and they are not aware that there is inflation. If you tell them that you give them 2% and then people will be excited and they will take it without holding back, okay? Now I am telling you, go there and have 6%, if not 10%, because you deserve it, it's your money. If they know that you know what you're doing, they will actually treat you better because they know you can decide and take it. Take it from BMO, take it to CIBC. If CIBC are not behaving well, you take it from CIBC, take it to TD. So once they know, like, you know what you're doing, they will treat you better and you will come and thank me next time. So let's continue doing the thing. What about if you're not that conservative and you don't want to give bank your money or maybe demand only $3 on your $100? So other people will just save. They will save for down payment and they will want to go buy that house. But in Canada, this is really a very difficult market. So it just depends on where you are. Like you can go to small cities, buy a house, you have a mortgage, but there are no people to rent your house because everyone can afford the house and they're all renting, they're all paying mortgage. So you wanted to rent it out to someone, now no one is renting it and you're just paying mortgage, right? It doesn't sound fun, right? So it doesn't sound fun at all. If you come to a big city like Toronto, right? Even affording a house is by itself, you need to have like some stable job, you're making some big, huge money, right? For you to be even qualified to get a mortgage, right? So if you succeed in getting mortgage in Toronto, right? There are a lot of expenses because it's like big city, right? You need maintenance, everything is higher, insurance is very high too. You're getting people who are willing to rent your house, right? But your mortgage is also high because you are renting. Your mortgage is high, how much you pay is high. So even if you put together the amount that you're charging the people who are renting a house and the amount that you're taking out of your pocket to pay for the house maintenance, do all those things, right? There must be no, you might have no cash flow at all. Maybe your expenses are equal to the income that you're getting from that rental property. So for you, if you want to survive in Toronto and then you just want to do business in Toronto, it will be a good idea to just do it as a long term. So you can just ask those people to pay, maybe pay, and then reduce your your mortgage. And then maybe later on, if the market price of the of your building appreciate, you can sell it and maybe start something new. So you have bought your house, and let's assume you were in like not very big city, not too remote. You are like somewhere in the middle in Canada, where it's like affordable, and the market is doing well. There are people looking for a place where they can stay. They are willing to pay rent at the market price. Let's see how you can just really fare with this one. You have a mortgage of 150, maybe you have paid $50,000 as a down payment, right? So how long will it take you? You have 10 years term to pay that mortgage off, right? Let's say, for example, you're charging rent, and then you have some few cash flow to help you maintain your house, right? But you are invested for long term, maybe 15 years, 30 years later, you know you are going to get something out of this, right? You're going to get something out of this. So you're keeping your head to the price. After 10 years, I know I'm going to be wealthy because this house price is going to appreciate, because at long term, we have been told market prices, house prices will increase eventually, somehow. Yes, and you will also start making rental income after you pay off your mortgage, right? So making rental income a year because you're renting out to people. And this rental income, let's assume that you're spending so much money to maintain your house and all these things. So at the end of the month, you're not even getting any cash flow. So let's wait 10 years later, we have paid off the house. So what happened? All this 15,000, you will be making it a month, a year, right? This is extra money apart from the job that you're doing. So after 10 years, this 15,000 will be coming from your house as part of your portfolio. This is how you make money, through investing. You invest your money in real estate. You had high hope. You have high hope that the price is going to increase. And maybe if the price of your house increase and you decide to sell, you make more money, right? Like some people, they can buy at 250,000 and then sell at 500,000. So the difference between the price that they bought it and the price that they sell it is like the equity that they build over time, right? Or if they want to keep it and continue collecting the rental income, they will be making money after they pay mortgage. Or even some people, if they maintain their expenses low and they get the rental income, the difference between their expenses and the rental income can leave them with some cash flow. So it's not that bad. In the long run, you can make money in real estate, even if sometimes it comes with a lot of headaches. So let's see. What happened then if someone does not want headache? Because real estate come with a lot of headaches. There's government regulation, it's a business, so you have to pay taxes, you have to deal with maintenance, all the bills like insurance bills, utility bills, all those stuff. Tenant making noise, some tenant burning your house, all those stuff. So you have seen that I cannot deal with that, right? Some people will be like, they will be like, no, I cannot deal with that. So then you have options of saving your money in a bank account and hand like maybe 5%, which leave you with 3% as a real return on your business, on your money. Or you can do stocks. And then stock market, stocks comes in different way. They pay people in different way. So let's see. So stock, in other words, a unit of ownership. Like when you buy shares of a company, you own part of that company. 100% of that company stocks that you have, under stocks, you own a percentage of that company. You're entitled to something, or maybe your unit of ownership can appreciate over time and you can sell it or transfer to other investors who want to keep going with the company. Say, but if you want, you decided today like, oh, I need to go buy like unit of ownership of a particular company. Where do you go? If you're in America, use the not you use New York Stock Exchange, right? If you are in America, you are in Canada, you use TSX. Maybe in Europe, they have other platform, right? So you can go there and see like things are traded there. How to buy stock and share, right? You just go. Some people, they go to banks, right? You go to bank and you tell them, you register, you use their platform to buy your own shares, buy your own stocks, and then they charge you fees. So most of the time, the bank brokers are very high. They charge you $10. So the moment you place a trade, or maybe you buy shares that you're going to hold for a long time, they're going to charge you $10 per the order you put in. So a lot of people, they avoid that. They avoid these people and they use online brokers. Me too. I use online brokers. And one of my favorite one is Questrade. So I am with Questrade. I buy my thing. Nowadays, I understand how the system works. They have some new features. They're good. You can play stuff on one day and they just fill up. So I use Questrade, and then again, other people can use Wealth Simple. So you can use that. So, and then what happened then? Next, which stock to buy? So you decide, right? So and then before you get into investing, most of the time it's like, you know what you're doing, right? Because if you come in without knowing what you're doing, and then you will be the victim, right? Because you would just be like floating in. You don't know what to do when what happened, right? So if like, for example, if you don't know, like you just bought shares, right? And then the next thing you see red everywhere. You see, oh, this money, I was supposed to keep them to go buy myself a primary resident. Look, what if tomorrow I wake up and then everything is gone? So you go back and sell it, right? So that is like someone who have no basic knowledge or about stock market, right? So you need to know when you need to go inside there when you understand what you're doing. So, and people who are selling this stock during the stock crash, the market crash, now they're crying, right? So you have to get in there, like when you understand what you're doing, right? So invest in your knowledge first, right? Invest in your first asset. Your first asset is your knowledge. Invest in your knowledge first, learn what to do, and then now come in. When you come in, you will be comfortable. You know, oh yes, I have risked this money and I don't care if I lose it. Or me, I need to keep this one safe because this money I need like 5 years later. I want to invest in dividend and not growth stock. Like you have to get in there when you understand, right? So let's see. So there are two types of stocks, like they have not two types, but how they have individual stocks and what we call ETF or index funds. So stocks, individual stocks is when you buy like specific companies. They maybe you say like, oh, I like BMO. In fact, I like BMO. I keep talking about them. So you buy BMO, that's an individual stock. You buy TD, that's individual stock. You buy Amazon, that's individual stock. ETFs is like now exchange traded fund, right? So it's like many companies, all these individual stock now coming together and form a stock that they traded in on the market, right? So these ETFs are considered to be safer than the individual stock. Why? Individual stock like BMO, banks, Apple, Amazon, those are individual stock. The disadvantage of investing in dividend stock, not dividend stock, individual stocks. Sometimes you never know, you cannot predict the market. You don't know what will happen. There are some well-established companies that have gone bankrupt and people who had invested in it were not expecting that, right? So for like people, new beginners, new investors, they're advised to, if they are investing for long-term, they need to use ETFs. They need to use those index funds so that they can be safe, because all those companies in that one index fund cannot just go bankrupt altogether. It's just well diverse kind of stock. What about if you invest in individual stock? Me, I like investing in individual stock because I say, okay, let me put 10% here, put 20% here, put 5% here. If this one die, I will be left with 3%, with the mentality that the one that I left will grow 2 times or maybe 3 times, for me not to really feel the loss that I got from the one that has gone bankrupt. But what if you are very careful and you just want to put your money in index fund, knowing that you will be you have no sleepless night worrying about the company going bankrupt. So you will buy like individuals, no, ETFs. If you're very careful, you don't want to worry about anything, put them in ETF, put them for long term. Market is unpredictable, like the way I have said, and then sometimes some companies that are very well established can go bankrupt. And there are a lot of examples. There was a time I was in accounting, financial accounting, right? And my professor came back. She was a lady, and she was talking about a company in the US who was accused of multi-practice, like unethical practices in the accounting sector, auditing, right? Where they give wrong information to investors, right? If they give wrong information to investors, wrong numbers, like these people who are public, they don't have much information to know how the company is actually doing, right? So they keep buying this stock from that company, hoping that this company is going to stay like 20 years later, because it was like some well-established company that had stayed for a while and they were paying dividend, or maybe paying, having a very good growth in their stock. So, but those companies went bankrupt, and one of them was Aon. And this is the company that she was talking about. So there was like some unethical practices that led to the this company going bankrupt. But the investors were not aware until that time that it hit zero, and they all lose their money. So the reason why they say individual stocks are not the best safe environment for people who don't want to lose money. No one wants to lose money though. So Aon became bankrupt, and there were a lot of investors who had put their money in based on the wrong information and misinformation, being told, oh, their balance sheet is really looking nice, and also maybe the income is looking nice, the price per share is higher, all those stuff, right? Sometimes they could lie. Some companies could lie just to keep on getting money from the public. So be careful. If you going to faint and die when you lose your money, avoid avoid individual stock. Avoid them, and then do the safest way, like ETFs. They are a bunch of companies put together. All those companies cannot just die in one day. So it's well diversified ETFs, put your money inside there. But if you can really hold and try not to have heart attack when you when one of your companies goes bankrupt, and then you can go ahead and buy individual stocks. It's fine, totally fine. So Aon died. This is what happened to their stock. It just hit zero, and everyone who had invested money into their companies lost their stuff. Sears Canada too. Sears Canada also died. They liquidated, and people who had invested their money there, they also lost. ETFs are good, safe, they're safe. So some of them are like XIC, Vanguard. Advantage of these ones, mostly they are less risky than individual stock, and because they are well diversified. Like I have said before, you can find Apple, Google, Amazon, and Walmart, whatever, all those energy companies, oil companies coming together, and they are all found in that one stocks. The only disadvantage for ETF, you have to pay some money so that someone can manage the fund for you. Otherwise, they're safe. You can put your money there instead of putting them in a bank account that does not give you any return. Stock can earn money through two ways: capital gain and dividend. So capital gain, like a company like Amazon, do not pay dividend. So you buy these shares, hold them, and with time, because they are growing, the price of your stock can appreciate, and then you can make profit by buying it low and selling it high. So that's the capital gain part of it. Dividend is like, as long as you own these shares, they will be paying you something monthly or after 3 months, so that the dividend will be regularly. And then people also own shares that pay dividend. They also can look forward to get capital gain. The price, the shares that you hold that give you dividend can also appreciate in price, and you can make profit once you sell them. Capital gain is, when you're talking about capital gains, there's unrealized gain until or losses. So until you sell your stocks, you have not gained anything. So if, let's say, for example, I bought stocks for $10, and then when I go back to the brokerage platform, I saw it has increased to $15. That $15 is not a profit until I sell the shares. But if I don't sell the shares, like tomorrow, I can come back and then there's the same stocks has gone back to $9 or $5. So you never lose anything, or you never gain anything until you sell your stocks, right? Number of your stocks is what matters. Like the value will be fluctuating every day. Like today you can see it's red, tomorrow is green, depending on how long you want to hold that shares, right? Those shares. If you want to hold them for a year, you will be seeing a lot of red, green, red, green, red, green, until the time that you will be selling it. And if you want someone who wants to make money in the stock market, you don't need to sell your stock when they are in red, right? You want to sell them when they're in green so you can make money. That was the point of you putting your money into the stock market. You want to sell when it's at gain. So do not sell your stocks when they're in red. Hang in and then you sell it later, unless if they are telling you like this company is going to go bankrupt tomorrow. And maybe sometimes they just lie, so you can just get out. So you can hang in. The value of the stock increase if there are more people willing to buy. That is the demand, right? And supply. If people are like seeing that the price is increasing, there will be more people wanting to buy, and then that will actually push the price up. Dividend stock pay you monthly, 3 months, or maybe a month. And disadvantage of dividend stocks is some companies do not pay dividend. Disadvantage of investing in stock, right? Some companies do not pay dividend, and they just promise you like they are going to grow, and then you will get profit by selling it high later. You can buy it at $50, sell it at 100. So they just promise you that. sometimes some companies just stagnate and they never grow. So it end up like you have only hold your money and you have not gained anything. Even someone who had your money in the bank, earning 3% as your real return on the money will be better off than you. Yeah, so you need to do your research as you invest in the stock market. Do your thorough research. If Apple is growing and they have potential, and then put in the Apple, because you know in 2 years time they're going to grow. But don't just put it in some companies that you don't know what they're doing and you don't even know whether they are going to grow, and then 5 years later you're still at the same spot. And then you would be the one suffering with inflation because your money has lost value and has not gained anything. Some cut dividend, right? They just come out of the blue and say, oh, now we cannot afford it, after they have enticed you to buy their shares. So again, you need to do your research and see what are companies that are dividend aristocrats. I don't know how to pronounce that. Right? So dividend kings, those that have been paying dividend for 100 years, 20 years, 5 years, consistently. So if you know those ones, you invest in those ones, not some sketchy companies that you don't know whether they are going to survive tomorrow. Or maybe they come back and say, oh, we are sorry, we cannot pay you dividend. And now you see the price of the stock is already in red. You don't know whether you should get out or stay. So for me, I would just wait and see if it's going to go up and then sell it and come out, right? But sometimes it doesn't work like that. You might even stay in red longer. So do your due diligence, practice and see which one. Be sure of where you're putting your money. That will save you tears. Disadvantage, dividend stock companies are like BMO, like I've said before, YouCan, and many more. There are some growth stock companies like Apple's, tech companies. They also have small companies that are growth stock. They just start up and they want money from the public, right? It's just like the way this thing operates. They want money from the public. You give them your money, you put your hope in their company, you know, like, oh, they're going to grow. You see, they will be like this company, they will be like this company. Now they're trading at $10. You see them like growing into 1,000. So you start seeing yourself becoming a millionaire and all this stuff. But sometimes it doesn't work like that. Some of them can even like go bankrupt the next day. So do your research and decide something that will not affect you in the long run. And that is the end of the video, and thank you for watching. If you like this video, subscribe for more videos, and I will see you next time. Comment and tell me what I can improve on, and we'll see you in the next session.